The market is inching green today, but energy is the undisputed leader as capital flees tech for the high-margin safety of the oil patch. The divergence between the SOXX's 2.4% jump and a neutral fear and greed index reveals a massive structural rotation into high-bandwidth memory suppliers rather than broad market speculation. While analysts chase macro headlines, the real signal is a supply chain bottleneck finally easing at the foundry level. Look at the SMH breakout to see where the smart money is actually landing. We score SMH a 63, a buy. Key signal is 4,068. This die size drives yields. SMH holds strong due to this tech. Our teardown reveals the semiconductor space is undervalued. SMH just hit a 14-day RSI of 83.3. That is not just overbought. It is a structural warning light flashing red across the entire semiconductor landscape. While mainstream media attributes today's 1.72% move to general AI FOMO, the lab sees a dangerous concentration in the silicon supply chain. This ETF has gained an astronomical 4,068% year-to-date, yet the internal architecture of the fund is narrowing. NVIDIA holds a massive 18.1% weight. It designs the architecture, but TSM at 10.6% actually executes the physics. Without TSM's leading-edge foundry capacity, NVIDIA's roadmap is nothing more than a high-end PowerPoint presentation. Broadcom adds another 7.8% weight, anchoring the fund to specialized networking silicon. Investors believe they are buying diversified exposure to a global industry. In reality, just 3 tickers control over 36% of the net asset value. We are tracking a fundamental shift where SMH no longer functions as a broad sector play. It has become a concentrated bet on advanced node lithography and high-bandwidth memory packaging. While CEOs like Elon Musk and Tim Cook prepare for high-stakes China diplomacy, SMH remains hyper-exposed to the Taiwan manufacturing bottleneck. Any geopolitical friction at that single point of failure will crater this fund regardless of demand. The momentum is undeniable, but the structural decay of diversification creates massive tail risk for late entrants. SMH is now a high beta proxy for global foundry capacity rather than a balanced semiconductor index. SMH has delivered a staggering 4,068% return year-to-date, making it the most aggressive instrument in the semiconductor sector. With an expense ratio of basis points, we expect surgical precision in fund design. Institutional capital is moving into the VanEck Semiconductor ETF with a 5D/20D volume ratio of 1.27x, signaling a clear inflow. This means money is pouring into the sector, driven by conviction, not speculation. The ETF is trading at a 1.690% premium to NAV, implying demand pressure is outpacing net asset value. Momentum is firmly bullish, with an RSI of 83.3 and a bullish MACD crossover. The current macro narrative suggests that tariffs and trade tensions are a major concern for the semiconductor sector. However, the lab disagrees, as the data shows institutional investors are not buying this narrative. In fact, the YTD performance of SMH is up 4,068.8%, indicating a strong sector trend. The fact that Elon Musk and Tim Cook are expected to accompany Trump on a China trip also suggests that there are efforts to ease tensions and promote cooperation, which could be a positive for the sector. While some may argue that the sector is due for a correction, the lab believes that the fundamentals are strong. The flow and narrative filter suggests that institutional investors are looking beyond the noise and focusing on the sector's growth potential. With a 3-year average return of 66.2%, SMH has proven to be a consistent performer. The lab's position is clear. We believe the semiconductor sector will continue to outperform, driven by strong demand and improving relations between the US and China. We're looking at a 4,068.8% year-to-date gain for the VanEck Semiconductor ETF, outpacing the Nasdaq benchmark. The bull case for holding SMH is rooted in the product cycle of 5G technology, which demands advanced semiconductors. This macro tailwind is a key driver of growth for SMH. While the top 2 holdings, NVIDIA and TSM, account for 28.7% of the fund, we see reasonable diversification across the top holdings. The current U.S. policy on tariffs does increase costs for companies like Intel and Texas Instruments, but the trend of artificial intelligence driving demand for graphics processing units is a stronger catalyst. NVIDIA's competition against AMD and Intel pushes innovation, driving growth for SMH. The CNN Fear and Greed Index at 49 provides a neutral backdrop for systematic ETF exposure. With an RSI of 83.3 and a bullish MACD crossover, SMH is poised for further growth. However, we must consider the downside risk of a global economic slowdown. The AI ETF score of 63 out of 100 indicates a solid but not outstanding investment. We at the lab believe the key level to watch is the support at $547.49. If SMH holds above this level, we expect the growing demand for 5G technology to drive further gains. The lab verdict is clear. SMH is a hold, with the 5G product cycle driving growth, and investors should watch the $547.49 support level closely. The iShares Semiconductor ETF earns a lab score of 63 and a buy rating today. While a relative strength index of 78 indicates the fund is technically overbought, the underlying hardware fundamentals remain exceptionally robust. We are tracking a significant expansion in high-bandwidth memory margins that the broader market has yet to price in fully. Our deep data teardown reveals the specific structural moat protecting these gains. SOXX surged 2.39% today to $532.76. This move isn't just momentum. It's a structural re-rating driven by the Cerebra's IPO pricing. Wall Street calls this euphoria, but the lab sees a fundamental shift in hardware valuation. AMD represents 8% of this fund and is currently pivoting from general-purpose CPUs to AI-specific accelerators. Broadcom, also at 8%, controls the custom silicon and networking fabric essential for data center scaling. Micron holds a 7.6% weight, providing the high-bandwidth memory that serves as the physical bottleneck for every AI chip. While the headlines focus on a potential Trump-led China delegation, the real story is inside the silicon. We are tracking an RSI of 78.8, which signals the ETF is technically overbought. This extreme momentum has pushed the year-to-date return into territory that defies standard historical modeling. Most analysts see a bubble, but they miss the hardware reality. We are witnessing the total replacement of legacy server architecture with specialized AI clusters. This transition requires massive capital expenditure that flows directly into the top 3 holdings of this fund. The marketing narrative claims diversified semiconductor exposure, yet these 3 companies dictate the entire NAV performance. We ignore the noise about trade wars when the order books for high-performance compute remain full through next year. The current price reflects a premium for supply chain dominance that competitors cannot bridge. SOXX will face a technical pullback, but the structural demand for its core holdings is permanent. SOXX is carrying a 6% anchor that is dragging down its entire performance profile. While the marketing narrative promises broad semiconductor exposure, the engineering reality of this fund is far more restrictive. The top 5 holdings command nearly 37% of the total net asset value. This is not a diversified portfolio. It is a concentrated bet on 5 specific hardware cycles. AMD and Broadcom lead the weightings at 8% each. Micron follows closely at 7.6%. However, the inclusion of Intel at over 6% represents a structural flaw. In a market rewarding fables design and AI accelerators, holding significant legacy manufacturing is a strategic drag. We see this failure in the peer comparisons. Over the last month, XSD outperformed SOXX by 15 percentage points. That gap exists because XSD captures the high-velocity mid-caps, while SOXX remains tethered to legacy giants. The fund reports a staggering year-to-date return exceeding 5,000%. This figure suggests a massive structural revaluation or a fundamental shift in how the index tracks price action. Yet the 3-year average remains at 56%. This disconnect proves the fund is struggling to maintain its historical growth trajectory. The lab views this composition as a mismatch between intent and execution. You are paying for a benchmark that is increasingly weighted toward yesterday's winners. SOXX is an outdated investment architecture that prioritizes legacy market cap over modern technical leadership. Institutional capital is moving into the semiconductor sector, as evidenced by the 5D/20D volume ratio of 1.23x, indicating a clear inflow of money. This signals that big players are positioning themselves for further growth in this space. The iShares Semiconductor ETF, SOXX, is trading at a 2.393% premium to its net asset value, implying strong demand pressure that's driving the price above its underlying value. Momentum is also on the side of the bulls, with the RSI at 78.8 and the MA20 above the MA50, indicating a strong upward trend. The current macro narrative suggests that the sector is facing headwinds due to geopolitical tensions, but the lab disagrees. We believe the data tells a different story, with the sector showing remarkable resilience. The fact that SOXX has returned 5,340.5% year-to-date, vastly outperforming its 3-year average, suggests that investors are looking beyond the noise and focusing on the fundamentals. The recent news about Elon Musk and Tim Cook accompanying Trump on a China trip may actually be a positive sign for the sector, as it indicates a potential thawing of relations between the US and China, which could lead to increased trade and cooperation. The lab's position is clear. We believe the semiconductor sector, as represented by SOXX, is poised for continued growth, driven by strong institutional inflows and a favorable momentum profile. The data supports our view, and we're not buying into the bearish narrative being peddled by some in the media. The iShares Semiconductor ETF is currently a victim of its own success, carrying a relative strength index of 78.8 that screams overbought. While the year-to-date gain of 5,340% dominates the headlines, the lab looks at the structural engineering of the fund. We see a massive concentration risk with AMD and Broadcom commanding 16% of the total net asset value. This isn't just diversification. It is a heavy bet on high-end silicon architecture and networking infrastructure. The bullish case rests entirely on the hardware refresh cycle for 5G smartphones and AI server clusters. These devices require the high-margin, advanced nodes produced by the top 10 holdings. However, the 63 out of 100 AI ETF score reflects a growing friction between innovation and policy. New tariffs on imported semiconductors will squeeze the margins of legacy players like Intel and Texas Instruments. These companies lack the pricing power of NVIDIA, yet they remain significant weights in the SOXX basket. We are tracking a bullish MACD crossover, but the neutral sentiment on the Fear and Greed Index suggests the retail narrative is cooling. Institutional capital is now positioning for a rotation out of overextended winners and into laggards. We do not chase the current momentum at these levels. Watch for a tactical retracement to the $506 support level before committing new capital. The era of easy expansion is over as trade policy begins to cannibalize semiconductor profit margins. SOXX will face a significant correction before its next leg up. Today's data confirms a structural buy signal across semiconductor ETFs. Is this breakout driven by real margin expansion or just more AI hype? Let us know in the comments below.